Welcome back to the deep dive. Today, we're heading overseas, you could say, diving into the pretty complex world of cross-border investments. Now, this conversation is part of the Journey series by ACE, which is a cross-border boutique investment bank, really centered around a global investor and business owner network. And our goal today is to explore this unique landscape of global deal-making. We're drawing insights from the ACE Navigator document you shared.
Yeah, it's fascinating, isn't it, to think of these deals not just as, well, transactions, but really as a journey of um, exploration and discovery. You're looking for growth beyond, your usual comfort zones.
Right.
And it's definitely intense. Both the investors and the private business shareholders involved, they feel things much more strongly. More anticipation, maybe more anxiety, but also more excitement than in, say, a purely domestic deal. Stakes are higher, more resources are involved. It's a real undertaking.
A real undertaking, but with potentially these limitless possibilities, right? Driven by that sort of people-to-people connection that's key in global partnerships. So let's start mapping this out. We generally talk about two main types, don't we? Inbound versus outbound. How do those work?
That's really the fundamental split. So inbound is all about pulling investment into a specific country. That capital might come from outside investors, foreign money coming in, or even from domestic funds that are set up specifically to invest only within their own borders. It's about boosting the local scene.
And those domestic funds, are they like mandated to stay home?
Often, yes.
Yeah.
Many have really strict mandates. Their whole investment thesis is built around, say, just Germany or just Brazil. They don't invest outside.
Yeah.
Then you also have sovereign funds. They're different, again, often state-owned, investing strategically, maybe into companies that import vital resources, that kind of thing.
Something I found really interesting in the ACE Navigator, and maybe a bit surprising, was that it's not just capital-strapped countries looking for inbound investment. Even really wealthy nations encourage it strategically. But there's a catch, right? The Navigator points out how companies go to these rich countries expecting easy capital.
Exactly. And they find, yes, there's tons of money, but those domestic funds are often mandated to invest only in that same wealthy country.
Ah, so the money stays home. A crucial point for anyone looking abroad for funding.
It really is. Shatters a few myths. So the flip side is outbound investment. That's about investing out into opportunities in other countries. These funds tend to be pretty large, often coming from economies where there just aren't enough domestic opportunities to soak up all the available capital. So they're almost pushed to explore the world.
Okay, so inbound pulls money in, outbound pushes it out. Makes sense that where an investor actually looks, their map varies hugely then.
Absolutely. It all depends on their specific investment thesis, how much money they have, their strategic goals. You might see mandates focused on just one country, or maybe a whole region like Europe or North America,
Yeah.
or even multi-regional mandates, say focusing on the EU and the US together, or perhaps just emerging markets versus advanced economies. Each carves out its own patch.
So we've got the where. Let's talk about the why. Why go through all this complexity?
Yeah.
Beyond just potentially larger funds, what are the real benefits of going global?
Well, the benefits can be quite broad, especially if you partner with investors who really have that global footprint and experience.
Yeah.
Yes, larger fund sizes are often part of it, but it's more than that. They often bring a wider range of deal structures, more flexible terms maybe.
More options than you might get locally.
Potentially, yes. Tailored structures maybe, designed for international growth. And crucially, having well-known global investors on your shareholder list, it acts like a stamp of approval. It can really attract other global financial players, open doors for future funding rounds, maybe even private placements, or eventually an IPO on a global stage.
So it's a credibility boost that attracts more opportunities down the line.
Precisely. And it directly helps with market access. Think about leveraging your investors network to expand your customer base internationally. That's how you achieve scale beyond domestic rivals. Plus, you diversify your funding sources, reducing pressure from maybe one dominant local player.
And there's more than just money and markets, right? What about sort of the operational side?
Yeah, definitely. Think about talent. Global investors can often help attract unique expertise, know-how from other regions. You also get access to maybe better strategic resources or supply chains through your network. And don't underestimate the cultural diversity they bring. Their teams often have high levels of, let's say, diplomatic skill, which is vital.
And intelligence, too, like market insights.
Huge benefit. An active presence in multiple regions gives them deep intelligence on economic trends, industry shifts happening elsewhere. That insight can be invaluable. It helps you benchmark your own strategies, adopt best practices from other markets. You can activate synergies, share resources, cut costs, and fundamentally, you diversify your market risk. If one region struggles, you're not solely reliant on it.
Right, spreading the risk geographically makes sense. You can also leverage their existing relationships, strike better deals maybe.
Exactly. With suppliers, logistics, retailers they already work with, you can sometimes use a competitive advantage from one market and apply it elsewhere, magnifying returns. And, spot arbitrage opportunities between markets that a purely local player might miss entirely.
Okay, the opportunities sound immense, but let's be real, it can't all be smooth sailing. What are the big hurdles, the challenges, the ACE Navigator highlights when you invest across borders?
Oh, absolutely. The challenges are significant. First off, your customers might be totally different. How they interact with your product or service can vary wildly. Market dynamics are unique everywhere. The competitive scene might heavily favor local players or be unexpectedly aggressive towards newcomers.
And the people side, culture.
Massive. Cultural differences impact everything. Shareholders, employees, negotiations, just basic business norms. Building trust takes time and effort in a new environment. Then you have practical constraints. Finding the right talent, setting up reliable supply chains can be much harder.
And the rules and regs?
Oh yeah. Laws and regulations are a minefield. Tax laws, labor laws, data privacy, they're different everywhere and need serious expert advice. Even the basic economics, pricing, costs, taxes will operate differently. Getting financing locally, even transferring funds can be complex.
So just moving money around isn't simple.
Not always. Plus, doing thorough due diligence can be tough. Getting transparent data, really understanding local performance from afar, that takes effort.
Yeah.
And you can't ignore politics. Even in stable countries, policy shifts or trade tensions can create unexpected risks or sometimes opportunities.
Okay, so it's complex. Given all that, how do you actually make a cross-border deal work smoothly? Ace Corp focuses on this, right, with their deal flow map and reports. What are the key tips for success?
Preparation is key, based on ACE's approach. First, really pinpoint the right markets for expansion and value creation for your business. Don't just chase trends. Then you need to genuinely build global expansion into your business plan. It can't be an afterthought. Show how the investment creates value through that expansion.
Be strategic about it from day one.
Exactly. And run the numbers on foreign exchange impact. Simulate how currency fluctuations will affect your financials both locally and when reporting back. It's crucial. Also, absolutely get advisors with both domestic and cross-border expertise. Tax, legal, audit, industry experts who know the target market's quirks. Don't go it alone.
Makes sense. Build a strong team.
Definitely. And another big one, get your domestic business model working well first. Don't chase foreign markets too early if things aren't solid at home. Prove the model, then scale. Also, really make an effort to understand and respect the local culture and history. It matters.
What about actually going there?
Yes, make short, focused visits, get a feel for the place, and try to find investors who already have teams and experience in those locations. Their groundwork is invaluable. And finally, keep an eye on the long-term cycles, demographic, political, economic. Think beyond the next quarter. Position yourself for the long haul.
This has been incredibly insightful. It's clear that cross-border investment is, well, it's complicated, full of challenges, but as you've laid out, the rewards for getting it right can be transformative.
Absolutely. Success really comes down to understanding that mix of opportunity and challenge and applying those strategic insights we talked about. Being prepared, mapping the course, knowing it's a different game.
So as we wrap up, here's something for you, our listeners, to think about. Given all these opportunities and these inherent complexities, how might a deeper understanding of cross-border dynamics reshape your strategy? Whether you're an investor, a business owner thinking about growth, or maybe just someone looking for opportunities beyond the familiar.